So yesterday, Nvidia reported earnings that were much better than expected. They beat on revenue, they beat on earnings, they were buying back 50 billion shares that they reported, raising their forward guidance. But despite that, the stock price dropped over 7% after hours. So does that mean that the Nvidia bubble has finally burst? And we'll also take a look at super microcomputer SMCI that just got accused of accounting irregularities that caused the share price to crater over 20% yesterday. Let's find out more in this video whether these are buys, holds, or sells. So yesterday, almost everyone in the market was waiting for Nvidia's earnings because Nvidia is one of the most valuable companies on the planet today. And their earnings didn't disappoint. They in fact reported better than expected earnings. Here's a quick summary. So their revenue came in at $30 billion, which was 1.3 billion above expectations. Their earnings per share came in at 68 cents, which was a beat of 4 cents. And they raised their quarter 3 2025 guidance to 32.5 billion in revenue, which was an increase of 0.8 billion. In terms of year-on-year increase, which to me is the most important thing, their revenue came in for the quarter at 30 billion, which is up 15% from quarter 1. But more importantly, year-on-year revenue, is up 122%. And their earnings, which are GAAP diluted share earnings, was up 168% from a year ago, and non-GAAP earnings was up 152% from a year ago. So as an investor, when I take a look at this, I ask myself this question. When I first valued this stock, it's based on certain growth projections. So when these earnings report come in, is it in line with the growth assumptions I made in my valuation? In the case of Nvidia, so far, pretty good. It is in line. In fact, it's slightly above what I projected in my valuations. So in case you don't know, I think I mentioned it before, my latest valuation for Nvidia, there's no change for the valuation. And my valuation is at, let's just take a look, $122. So that is my intrinsic value of Nvidia. Now, because Nvidia, there is, again, a bit of uncertainty of their future growth. So I like to have what I call an optimistic growth projection, or rather base case, and a more pessimistic. Like if everything goes wrong and they don't grow as much as people think, then what are the shares worth? Okay, so for my pessimistic valuation, it is $94. So that is my conservative valuation. That's my base case valuation. So this is what I call my valuation range. So once I know my valuation range, it becomes very simple, right? As long as the stock price goes below the intrinsic value, and I've got a margin of safety, I would happily add more shares. Okay. Now, but given I already have kind of like a full position in Nvidia. Nvidia is already about the 5th largest position in my portfolio. So I would not add more unless it gets much cheaper. Okay. So what I do for all my subscribers in the Ultimate Investors Playbook is that I will update the intrinsic value of every stock every month. But of course, you can do it yourself. You can always download my intrinsic value calculator as part of the Whale Investor course. Learn how to value the stock. It's really simple. It takes 10 minutes to do it, and you can do your own valuation. Okay. So you can see for every stock, I've got my valuation range, and I also identify at least 3 to 4 buy points where I would add shares. And these buy points are based on technical analysis, based on support levels. So you can see that for Nvidia, my support levels where I would add shares as an investor would be 105. That is my first buy level, right? Which gives me a margin of safety below the intrinsic value. 105. The next support level to add would be $95. These are the black lines. Next level to add would be 75, and finally $71. So given that I already have quite a bit of Nvidia shares, I won't add more even if it drops to 105, because to me at 105 it's okay, it's below valuation, but it's not super compelling, right? So I'll only add more personally if it gets to nearer $95. So what I did a few days ago, which I sent the notification to my subscribers, was I sold cash secured put options at 97 strike price. and I collected a premium of about close to $2 premium, right? So which means if Nvidia stays below $97 in 30 days, I'll be assigned Nvidia shares at $97 strike price minus the premium I collected. My average purchase price for more Nvidia will be $95, which I think is a damn good deal. Okay, but I think for now, I don't think Nvidia will drop below 97. It looks like it dropped 7% after market hours. And today, if you take a look at the pre-market, you can see Nvidia is trading at a pre-market of 121 right now. So unlikely that right now it's going to drop below 97, and unlikely I can add any shares. Yeah. Okay, but having said that, if I was an investor with no Nvidia shares and I wanted to start buying, would I buy at this price? No, I won't, right? Because it's right now at the fair value, it's at a fair price. But as an investor, we want to only buy when it's below the valuation, so we get a margin of safety. So again, as a new investor, to add it for the first time, I want to get it at least at 105. So does it mean that it's going to go to 105? Of course not. We can't predict the future. If it doesn't, so be it, buy something else. There are a lot of fish in the sea. If it goes to 105, great opportunity to add more Nvidia. Now, the funny thing is that, some people would be asking, they say, but Nvidia has gone up so much in the last 2 years or so. And is it the end of the run for Nvidia? Is it, is it at the top of the bubble? And they like to compare it with Cisco. Those of you who are old enough will remember that during the dot-com boom, the dot-com boom started in late 1994 to 2000. So that was a time where people went crazy. Oh, the internet's going to change the world and everything of a dot-com. People bought and share price went up even for companies that were not making money, right? Now, at that time, Cisco was the most important company for the internet revolution, right? Because Cisco was involved in building the backbone, the infrastructure of the internet. Very similar to Nvidia, which is now building the infrastructure and backbone of the AI revolution. So it's a pretty good comparison, right? So, sure enough, Cisco, their revenue was growing, their share price was going, and eventually, of course, the bubble burst because it got ahead of itself, and then it collapsed, and slowly it's coming back up, taking a long time to go back up. So people are saying, hey, is Nvidia also at the end? And this is a very good question. To answer that question, let's put them side by side, and let's see if we can find any similarities. So first, let's take a look at the dot-com bubble, or dot-com boom, which turned into a bubble. So the dot-com boom started in late 1994, and it peaked in the year 2000, where the bubble burst. So it was a 6-year run for the dot-com boom. So during this 6 years, Cisco, which again was the most important company in the internet revolution, their revenue during that 6 years, their revenue increased 1,400%, which is 15-fold. And at that time, their share price increased 4,100%, which is 42 times. Okay, so where is Nvidia now based on this comparison? So the current AI revolution started with the launch of ChatGPT, which was late 2022. In fact, November 2022. So from then to now, which is August 2024, it's about 1.7 years. So if you compare that 1.7 years to 6 years, there's still a couple of years to go if you want to do that comparison, okay? Now, so far in this 1.7 years, what has happened to Nvidia's revenue? Nvidia's revenue has increased 400%, or 5-fold, which again is nowhere near Cisco's revenue that increased 15-fold. So in other words, Nvidia could still have a long runway to go in this AI revolution, all right? At the same time, from the start of that AI revolution, ChatGPT launching, Nvidia's stock price has increased 830%, or 9.3-fold, which some people would think, whoa, it's already gone up 9 times. How much higher can it go? Hey, Cisco went up freaking 42 times. 42 times! We could be just at the beginning. Okay? So because of that, no, I ain't selling shit. I'm not selling my Nvidia shares. I'm holding it for the 42x. Yeah, okay? Will it get there? I don't know. You will get there. I think so, right? Maybe more, maybe less, but somewhere around there. Now, having said that, you may say, but Adam, if you're so confident it's going to go up so much more, why don't you just go and buy more now? Why? Because, remember, nothing goes up in a straight line. The stock price will not go up every day, every week, every month, every year for the next 4 years, right? There will be big ups and downs. It'll be like a roller coaster. So I don't want to jump in while it's still near a high. I want to get in after a wave down. Like Buffett always says, you've got to be greedy when everyone is panicking, everyone is fearful, people think we're gonna die. That's when you get a damn good price. That's when you buy the share price way below the intrinsic value, you get a margin of safety. Okay. By the way, if you take a look at Cisco went up 4,000% the share price. But during that 6-year run, Cisco's stock price had multiple declines or drawdowns of between 20 to 30% during its ascent. So similarly, I can tell you that although I think Nvidia can still grow tremendously in the next 4 years, there will be crashes, or we wouldn't call it crashes, there will be pullbacks or drawdowns of 20 to 30%. There will be. I can guarantee you that. In fact, who knows? Right now we could drop another 20%, right? We could, I don't know, right? So there will be opportunities to add more in the future. So that's why I would say, don't chase the girl. When a girl runs away, don't chase the girl. Wait for the girl to run into your arms when she's fearful, because she'll always get fearful once in a while. Or guy, whatever is your gender preference, right? Let me talk about super microcomputer, SMCI. Holy shit, right? The stock price is down like 64% from the high, from 1229, it's down 443. And pre-market, it looks like it's going down more to 427, 430. So of course, I've got questions from people. Is this a buy? Is this an opportunity to buy a stock when it's down so much? When it looks like it's really undervalued and people are panicking? First, let me set the record straight, okay? If you guys recall, 6 months ago, I made a video about SMCI because it was one of the hottest stocks. And I said at the time that my intrinsic value calculation was $1,006. Okay, and I said if it goes below that to these buy levels, it could be something to buy, right? I said that. And then after SMCI crashed, especially the last few days, people say, hey, you said it's cheap. What's going on, Adam? Obviously, these people didn't read my follow-up post, okay? Because after I created this video, I did more research into the company and I said, oh shit, I don't think I'm going to buy it anymore, right? I found some things that were really concerning, and I actually posted this on all my social media, including YouTube, and this was 6 months ago, and it was there, right? And I said that, yep, although SMCI looks like a very profitable business with revenues growing, and blah, blah, blah. However, I had a few concerns that do not meet my investment criteria. As you guys know, I only invest in the top 1% of companies in the world that are very, very, very safe, that are very predictable, that are very consistent. And once I find there could be something wrong, no thank you, I don't buy that, right? That's the reason I don't buy Snowflake or Peloton or Tesla, because, all these companies, there's always something wrong, which no thanks, I'm going to avoid them, right? So for SMCI, what did I find wrong? Number one, the company has inconsistent negative free cash flow in certain years. So whenever a company has got revenue growing, profits growing, but free cash flow negative, usually there's something wrong, there's a red flag, they could be doctoring their accounts. And I've seen that before in other companies, like in Singapore, one company called Hyflux, and another one that was, Nobel Group, same issue, right? So when I looked at it, I said, okay, I think something's wrong. I'm going to avoid that. Yeah. Next, high customer concentration risk. A significant percentage of revenue comes from a few customers. That was another concern. They don't have a very strong economic moat, right? So basically, SMCI, their products, they look like IKEA shelves. Okay, right? And while their moat is stronger than Dell and HP, it is not strong enough a moat, an economic moat, for me to be comfortable in. At the same time, their core components used in their servers are commodity components that can easily be replicated by other players, right? So because of that, I said to my subscribers, I shared on my social media, I said, I won't buy this stock, all right? So to set the record straight, I already said so, don't buy it. Yeah? Now, but to be, and after that, what happened was obviously the stock started going down. Okay? But then what happened was 2 days ago, Hindenburg, which is a research firm that specializes in finding companies that engage in fraud and they short these companies, they said that they found that SMCI, they accused SMCI of doctoring their accounts. Now, this was something that is very hard to predict. Okay, now I didn't predict it myself. Right? So, and the whole thing came down. There's no way to predict it, but it happens. Okay, so the stock cratered in the last 2 days. So the question is this an opportunity to buy? And from my experience, I will never touch these kind of stocks. Here's the thing. I love great companies when they're hit by bad news. All kinds of bad news, like they miss their earnings, they miss their revenue, China weak. I'll buy it because these are solvable problems. These are short-term issues. But the moment a company is accused of financial irregularities, once they're accused of doctoring their books, I will never touch this company. Why? Few reasons. Number one, you don't know how deep the rabbit hole goes. When there's smoke, there's fire. And whatever valuation I did, where I calculated the intrinsic value, which was $1,000, is based on data that I thought I could trust, based on revenues and earnings, right? But now if you tell me that all these are doctored, they are misrepresented, then what's the intrinsic value? It could be anything, right? The value of the stock could be 1,000, it could be 500, it could be freaking zero, all right? So, no thank you, I'm not gonna buy this kind of stock. It's kind of like in a marriage, for example. If your husband or wife makes a mistake, for example, they lose their job, their business goes bust, you stick with them through thick and thin, right? Because they can solve the problems. But the moment you catch your husband coming home with lipstick on the shirt or a condom drops out of his pocket, the marriage is over, right? You know that you can't trust this guy anymore, okay? And the worst thing is that if you caught him cheating before, and it's not the first time. And in fact, this is what is happening to super microcomputers. So it is not the first time they're being accused of fraud. They were accused before, they admitted it, yeah, we did it, they paid a fine, and they're doing it again. Or it looks like they're doing it again, right? So that is really scary. So this is from the report of Hindenburg, and they found glaring accounting red flags, evidence of undisclosed related party transactions, sanctions that they went against, export control failures, and customer issues. In 2018, by the way, I did read this before. I forgot that I read it, and now it became clear. In 2018, Supermicro was temporarily delisted from NASDAQ for failing to file their financial statements. And by August 2020, the company was charged by the SEC for widespread accounting violations. So they did this shit before. They were caught cheating before. It's not the first time. And it was related to $200 million in improperly recognized revenue and understated expenses, resulting in artificially elevated sales, earnings, and profit margins. Here's a scary thing. Less than 3 months after paying $17.5 million fine for their wrongdoing, they fired those executives who were dishonest, but 3 months later, they rehired these top executives that were directly involved in the accounting scandal. It's like, okay, let's do it again. Right? Shit, right? It's like, again, you caught your husband cheating, he broke up with that girlfriend he was having an affair with, and then he meets that girl again. Okay? And a former salesperson told us that almost all of them are back. Almost all the people that were let go, that were the cause of this malfeasance. How the hell do you pronounce this? Malfeasance. Oh, that's beyond my English comprehension. They are back. Okay? So, yeah, because of that, you know what? I'm not going to touch this stock. If I was in this stock, I would just get out. Now, again, is it possible that after I sell, the price rebounds back up? Of course it's possible, right? I can't predict the short-term movement, right? But I'm not willing to take the risk because I've seen this movie before. Companies that are accused of financial fraud, if it is really, really bad, the company can go to zero, right? So if I own the shares, I'd rather lose 30% of my money or 40% than freaking 100%. And for those of you who are not old enough to remember, these two companies really taught me this lesson to avoid companies once they are accused of financial fraud. The first is WorldCom. WorldCom was the second largest telephone company in the US at the time, and WorldCom was in the Dow Jones Industrials Average. It was one of the biggest companies in the world, and in the S&P 500. And it was selling at $55 per share. And once they started to be accused of financial fraud, their CEO resigned, and the stock basically went to zero. Another one is Enron. Again, Enron was one of the biggest companies in the world. So these are not small companies. These were huge Dow Jones Industrials, S&P 500. And Enron was named America's most innovative company for 6 consecutive years. It was one of the biggest energy commodity companies in the world. And from a share price of $86, again, once they found that the revenue and profits were fraudulent, they were all fake, right? Stock went to freaking zero. So all I can say is, and this is something I teach in my investing course, that once a company is accused of financial fraud, get out. Just get the F out. All right. So that's it for this video. Hope you learned something. May the markets be with you, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.